Hello, I'm Julie Price and welcome to Juniper's third quarter 2021 economic outlook. I'm so glad you tuned in. Thank you very much. Following a challenging 2020 and start of 2021, the U.S. economy is surging, powered by the fading of the pandemic and massive fiscal stimulus. As we enter the third quarter, U.S. vaccinations have increased significantly, with over 50% of the country having received at least one dose of the vaccine. Equity markets have rallied and home prices have surged, with household net worth rising over 17% since the end of 2019, according to JP Morgan. Fiscal stimulus geared toward lower and middle income households has put more cash in the hand of those consumers who are most likely to spend it. These factors have allowed the sectors most adversely affected by the pandemic to show strong improvement, contributing to a powerful pickup in GDP growth that should push the U.S. past pre-pandemic output levels before the end of the year. The months ahead will still see economic challenges as strained supply chains, rising inflation, and labor market distortions from the pandemic remain headwinds for the U.S. In addition, pressures are mounting on the Federal Reserve to begin unwinding some of its pandemic-related stimuluses. And questions remain on what higher inflation will mean for equity and fixed income markets going forward. Any investment strategy should start with a broad assessment of these fundamental issues. To help us out, we turn to JP Morgan's Guide to the Markets. There are 77 pages in the guide, so I'm boiling it down to just 15. We start with an update on progress on combating the pandemic. Then we look at the pace of recovery, considering trends in economic growth, jobs, profit, and inflation. This is followed by comments on fiscal and monetary policy. Finally, we consider the implications of all this for those investing in U.S. fixed income and equities, as well as international equities. And we highlight the importance of investing in a diversified way in the still rapidly changing environment. Join me while I discuss these topics using analyses from the experts at JP Morgan. We looked at this chart in last quarter's video. After more than a year of rigorous social distancing measures and a terrible human toll from the pandemic itself, the U.S. is now progressing rapidly toward herd immunity. On the left side, the blue line shows new cases falling from a daily average of over 260,000 in early January to just 15,000 as of late June. At the start of the third quarter, over 50% of the U.S. population and over 86% of people over the age of 65 have now received at least one dose of the vaccine. This begs the question, where are we on the road to herd immunity? Coupling vaccinations with the total number of individuals who have already had the virus, JP Morgan estimates that over 70% of the U.S. population has at least some immunity to COVID-19, moving us closer to the 70 to 90% range that experts have suggested could represent herd immunity. However, the pace of vaccinations has slowed and new strains of the COVID-19 virus have emerged. The U.S. will need further progress on vaccinations, but growing immunity along with better testing and the potential for booster shots should allow the number of cases and fatalities to remain low, allowing life to largely return to normal. Aside from vaccinations, we have seen unprecedented fiscal stimulus from both the previous and current administrations that has really been an accelerant for the economic recovery. The $1.9 trillion American Rescue Plan is still working itself through the system and will continue to support the economy through the end of the year into 2022. The right-hand side shows the impact of the recession and stimulus on the federal budget. The projections shown are for the deficit and debt as a share of GDP and are based on February projections increased by spending under the American Rescue Plan. Now, these projections are likely an underestimate of the pace of growth in federal debt because they exclude additional spending aimed at infrastructure, child care and education, and other initiatives. They also assume the individual tax cuts contained in the 2017 Tax Act expire on schedule at the end of 2025. On the left, the CBO is assuming a continuation of the very low long-term interest rates, even in the midst of an economic recovery and huge deficit spending. Two significant changes from last quarter are that income tax revenue increased from 25 to 29% and borrowing decreased from 50 to 44%. A more realistic view on the federal budget over the next year suggests that the federal government will hit a new record high debt to GDP ratio by the end of 2021, even higher than in the aftermath of World War II. As you're well aware of from my previous videos, if the government fails to rein in deficits and debt monetization as the economy accelerates, the risk of a boom-bust recession will grow. Specifically, a sharp rise in inflation could result in higher interest rates and higher taxes and could ultimately set the stage for an economic relapse. We've been monitoring this slide for the last few quarters. Following the collapse in the second quarter of 2020, economic growth surged in the third quarter of 2020, moderated over the winter, and has now re-accelerated, tracking above 10% annualized real GDP growth for the second quarter of this year. Blockbuster consumer spending on goods and an anticipated resurgence of spending on services, along with rebounding investment spending, could push the economy to a full GDP recovery by the third quarter and to 7.5% year-over-year growth by the fourth quarter of this year. Now, this would also be up 5% from 2 years ago, more than exceeding the 2% trend growth that could have unfolded if the pandemic had never occurred, reflecting strong recent productivity growth. We expect growth to then fade over the course of the year, returning to the roughly 2% pace it saw at the end of the last long expansion. The surge in GDP has been mirrored by an acceleration in the labor market as the economy reopens. After shedding an astonishing 22 million jobs between February and April 2020, the labor market has now recovered almost 15 million jobs, or 66% of the total loss since April 2020. This recovery in the labor market is encouraging, but is still far from complete, with an unemployment rate still at an elevated 5.8%. We are seeing that demand for labor is exceptionally high as businesses are having a tough time keeping up with pent-up consumer demand. Here we see the steep rise in the number of small business owners reporting difficulty in filling job postings. This mismatch of record high job vacancies and high unemployment shows that the shortcoming in job creation is really an issue of labor supply. Prolonged enhanced unemployment benefits, lingering pandemic worries, childcare responsibilities, and early retirements have likely added to the crunch. Supplemental employment benefits are set to expire in half the states by early July and in the other half by early September, which should eliminate most of the current distortions in the labor market. This should allow the unemployment rate to fall below 5% by the end of 2021 and to a more normal level between 3.5% and 4% by the end of 2022. With labor demand surging and a higher cost of low-wage labor due to enhanced unemployment benefits, employers have had to raise wages to lure people back to work. This is critically important for the Federal Reserve, as higher wages could lead to inflation that is less transitory than the Fed currently expects. If higher wages and consumer prices get embedded into inflation expectations, inflation pressures may rise long before the unemployment rate falls to a level that the Fed would deem maximum employment. The deep recession in the economy was paralleled by big declines in S&P 500 operating earnings in early 2020. However, earnings have recovered substantially since then and now look set to hit a new all-time high in 2021. This is partly due to sectors like technology, communication services, healthcare, and consumer staples, seeing few negative impacts from the pandemic and, in many cases, saw stronger revenues. The thin party lines in the Senate and House also suggest that President Biden may not be able to implement the tax increases on corporations that were in his pre-election plans, which further makes the case for strong earnings in the short term. However, fiscal pressures like the upcoming infrastructure bill may lead to tax increases later in the decade, and this, combined with rising wages and higher interest rates, should lead to a sharp slowdown in profit growth at that time. Early last year, the Fed slashed rates to a range of 0 to 0.25% and aggressively added to its balance sheet. I've been talking about how the Fed adopted an average inflation targeting operating strategy last August, where they have been aiming for average inflation of above 2% for some time to make up for years of undershooting this target. In order to achieve this, they have pledged to hold the federal funds rate at its current target range until average inflation is at 2% and on track to moderately exceed 2% for some time. At its June meeting, the Fed updated its interest rate and economic projections by increasing its real GDP estimates. Along with its more optimistic outlook on the economy, the committee has also shifted to a slightly more hawkish stance. This chart shows 2 rate hikes sometime in 2023, up from no rate hikes from the March meeting. They are also actively discussing a timetable for tapering its massive bond purchases. Just to recap on the recent history on inflation, the onset of the recession combined with the collapse in oil prices triggered a decline in already low inflation, with the year-over-year change in the CPI falling to just 0.2% overall in May of 2020 and 1.2% excluding food and energy. And here's the average inflation line. Inflation has heated up recently as a surge in consumer spending collided with supply shortages. The year-over-year gain in CPI rose to a striking 4.9% overall and 3.8% excluding food and energy in May 2021. Stronger growth is often accompanied by higher inflation, and the Fed continues to regard near-term spikes in inflation as transitory. The Fed has also become more tolerant of inflation overshooting their 2% target for a period of time, and these conditions could put the Fed's new framework to the test. So, what does this all mean for investing? For fixed income investments, the challenge is that the combination of very easy monetary policy and a recession has left the 10-year Treasury yield close to 1.5%. With rising inflation, interest rates will likely move higher over the course of the year. Nominal yields include inflation while real yields don't. So if you take 1.45% and subtract 3.8%, you get negative 2.35%. Real yields decreased from 0.46% last quarter. Despite increasing wages, home prices, and consumer prices, long-term rates have held steady around 1.5% after being up to 1.7% earlier this year. The liquidity facilities established by the Fed to protect other parts of the bond market have tended to compress credit spreads. Essentially, this means that investors are willing to pay more for bonds without as much consideration for their credit quality. There continues to be a place in portfolios for fixed income to provide diversification and protection in the case of an equity market or economic relapse. However, these technical factors suppressing long-term interest rates will not last forever, so we focus on shorter duration bonds to be well positioned for when long-term rates rise. So far, 2021 has seen high valuations and rising earnings estimates, which has allowed the equity market to trend higher during the first half of the year. Stock prices based on current forward PE ratios still look high, although they have come down somewhat as earnings have played catch up. As a reminder, earnings is the E in PE. Earnings are likely to continue to grow quickly in the remainder of the year, which should lead to a further reduction in PE. Relatively low interest rates likely justify some elevation of valuation. However, higher inflation, corporate taxes, and wage pressures will likely put further pressure on equity valuations within the next few years. The challenge for investors from high PE ratios on stocks and low yields on bonds is illustrated here, which shows the earnings coupon yield on a 60/40 stock bond portfolio. The earnings coupon yield is constructed by adding 60% of the S&P 500 forward earnings yield to 40% of the yield on the Barclays Aggregate Bond Index. This is now close to a record low and suggests that returns on a plain vanilla 60/40 portfolio should be very low in the next few years. This highlights the urgency of finding other ways to boost portfolio returns without taking on excessive amounts of risk. I've dealt with this in many portfolios by further diversifying the equity allocation using value and international, and the fixed allocation with high yield, emerging market bond, and alternatives based on client needs. After multiple years of strong outperformance of growth stocks, especially last year, value has begun to recover. But with the S&P 500 up more than 15% year to date and certain parts of the market looking stretched, what's in store for the back half of this year? Does value still have room to run? The left-hand side shows that value appears to remain cheap relative to growth compared to long-term averages. Additionally, as interest rates should rise further, value generally tends to outperform growth during periods of above-trend economic activity and rising interest rates. This is because the earnings of value-oriented sectors tend to be more sensitive to the pace of economic growth, as shown on the right-hand side of the chart. Now, this doesn't mean that we should abandon growth stocks altogether, as the economy is likely to slow down to a much slower pace of economic growth later in 2022 and in 2023, and growth stocks have traditionally outperformed value stocks in a slow economic growth environment. Let's look at international equities. We hoped that the global recovery would be more synchronized, but the expectation has not been derailed, and vaccination progress is now gaining speed globally. Europe, in particular, has seen a substantial improvement in vaccinations, and upcoming fiscal support from the EU Fiscal Recovery Fund should benefit the region. Increased vaccination should also provide a boost to Northeast Asia in the second half of the year, while emerging market nations should also approach herd immunity by year end, although more so via infection than vaccination. Both emerging market and developed country stocks are selling at some of their cheapest levels relative to their U.S. counterparts in the last 20 years, as we see here. This chart shows the range of global PEs, or valuations. The purple bar, the 25-year average, and the blue diamond shows the current valuation. So you can see here how much the U.S. is overvalued compared to other areas. This slide shows the S&P 500 valuation dispersion over the last 25 years, illustrating that with the upside of strong performances comes the downside of higher valuations. The current S&P 500 valuation spread is markedly higher than the 25-year average. We'll conclude this quarter's economic review with a look at the matrix as of June 30th. Real estate and commodities shot to the top at 21.3% and 21.1% year-to-date, respectively. U.S. small-cap equity remained strong after being in the top slot last quarter, up 17.5%. U.S. large-cap equity up 15.3%, with international developed and emerging markets following next. And here's high yield and fixed income rounding out the bottom, up 2.1% and down 1.6% respectively. This is a big improvement for fixed income, which was down 3.4% last quarter. In review, the U.S. economy is looking in great shape as we enter the third quarter, and continued progress on the pandemic at home and abroad will be vital in keeping the pace of the global economic recovery. Given the substantial progress markets have made in recovery, we should focus on the fundamentals we've discussed and maintain a diversified stance, taking advantage of more active management as we enter a new era in the post-pandemic world. Thank you very much for making it all the way through this quarter's review, and as always, please feel free to reach out to me to review this and more.